Hello, everyone. Thanks for checking in today. I'm talking about qualifying for a mortgage. What is the best product out there for you? What are you looking at in terms of your finances and qualifying? Where do you fit in? And how to put together and locate the best deal for you in today's market. I'm going to talk about FHA versus conventional loans. I'm going to talk about looking at your housing expenses, what goes into your interest rate. I'm going to touch on APR and variable rate adjustable mortgages. So please stick around. Thank you for watching. I hope you enjoy. Hit that like button and subscribe and stay tuned. We're going to get real smart today. Bye. All right. Thank you again. I'm Rob Rivera, licensed real estate agent, licensed mortgage originator. I'm located in the Bronx and Westchester County. If you have questions, you can always send them directly to me. My contact link is in the description of the video. Hit me on WhatsApp, email me, drop me a line, leave a comment on this video, and definitely like. Okay. And again, I'm coming to you with the number one goal, which is equity growth. I want to give you the tools, the information, so you could build wealth for yourself and your family from now into the future. All right. So let's jump right in and let's talk about qualifying for a mortgage. In today's market, and just in any market in general, how do you qualify yourself for a mortgage? What are what are you allowed to have to spend? What kind of credit scores in that do you need? Okay, let's just look real quick at FHA loan limits. All right, for the first starting step, qualifying for a mortgage, your household monthly income and your credit score are going to be the two most important things. Okay, your credit score is going to jump the interest rate or APR, the cost of a mortgage, up or down. But you need to qualify for the home first with your income. So if your household monthly income is $70,000, you make 70, maybe wife makes 70. Total household monthly income $140,000 a year. That is $1,166 a month. Okay, to qualify, so that means if you want to qualify for an FHA loan, you could get a house or get into as the housing expense, the principal, interest, taxes, insurance, association costs less than $3,616,000. Okay, 31%. For a loan, that number is 3,200. All right. If your income is $150,000 a year, all right, you could borrow a little bit more. Again, this is just housing expense. This just speaks specifically to what your income versus the cost of the house for you guys going forward. Okay. And then debt service. Debt service is going to be all of your the housing expense plus whatever the hard payments are on your credit report. Okay, student loans, auto loans, and then anything government ordered, like maybe you're on a tax repayment plan, if you're paying child support, alimony, all of those payments monthly plus your housing payment is your total debt service. So the total amount that you could possibly pay out of pocket, according for underwriting purposes of a conventional mortgage loan, is $4,500 a month for a conventional loan, $5,375 a month for an FHA loan. So again, a little bit of the difference, what's conventional versus FHA. FHA loans are in place to expand the buyer pool for mortgages, okay, to make mortgages available to more people. Banks, traditional banks, they would likely only extend this line of credit at this interest rate to a more qualified to buyer. I'm going to look real quick at just what the actual credit score qualifications are. Let me bring this up for you quickly here. Sorry about that. Okay, so for a conventional loan, debt to income ratio, again, you have a 28% housing ratio, 36% debt service ratio coverage. You can put as low as 3% down on a loan. That means you could borrow up to 97% of the value of the home. Your credit score should be about 640, the FICO score. It can go a little bit lower, but it depends on how the deal is put together. Loan limits, conforming loan limits, the Federal Housing Finance Authority, the FHFA, loan limit for 2021 for a conventional loan is $548,000. Can you borrow more than that? Yes, you can. Right, it would still get it on the loan, but it's technically a qualifying government backed loan. So FHA loan limit $548,000 for 2021. It did go up, as you could see. In 2020 it was 510. They're raising it with the prices of homes continuing to go up. Private mortgage insurance, you are required to have private mortgage insurance. This covers the lender in case you default on loans that with a less than 20% down payment. So you are technically at a greater risk for not repaying the loan if you don't have as much equity in it. This is in place so banks feel more comfortable lending loans out to people without that don't have the ability to buy a large chunk of their home all up front. Private mortgage insurance is required on loans with less than 20% down across the board, FHA, conventional, no matter what. Appraisals are required unless Fannie Mae or Freddie Mac give an appraisal waiver, and that goes through automated underwriting. Automated underwriting is Fannie Mae or Freddie Mac's. They have two separate automated underwriting systems. When your loan application, all of your proof of income, tax history, the purchase contract for the house, everything gets uploaded into either a desktop underwriter or loan processor. One is Fannie's, one is Freddie's. They both do the same thing, and they can automatically qualify you for the loan. If they can automatically approve the mortgage and the house and qualify the loan, issue a commitment. If you could pass that automated underwriting, you don't need an appraisal. If not, then an appraisal may be needed. Okay, are gift funds allowed? Yes, they are. Gift funds are assistance with down payment. It's allowed from blood relatives. So your wife, your mother, your brother, maybe an uncle or a grandparent, a blood relative can give you a down payment assistance or closing cost assistance. They will need to sign a waiver that says that this money is not intended to be paid back. So it cannot be a loan. A gift fund is not a loan. It is something where it is a gift, just like it says, it's a gift. Okay. If you have had a bankruptcy for a conventional loan, 2 years from a Chapter 13 discharge or 4 years from dismissal, 2 years with extenuating circumstances from a Chapter 7 filing. If you have foreclosed on a home, you can get a conventional loan 7 years from foreclosure or 4 years from a short sale. And if you are doing a cash out refinance, they'll allow you to take out 85% of the value of your home cash out for a refinance. Okay, that is huge. We're seeing a lot of people do those refinances over the last couple of years as interest rates dropped, as equity increased. People made a lot of money out of the value of their home. If you are looking at getting into a home, you don't have one yet, you'll find out, a few years after you get it, how valuable that is how valuable your home is as a cash flow tool, using some of these cash out refinances to expand or better, your life. For a conventional loan, and this is important here, you usually need 2 to 4 months reserves after down payment and closing costs to also qualify for a conventional loan. Okay, so think about this. 2 to 4 months means 2 to 4 months of the housing payment. So $50,000 down, $20,000 to close. This house costs $3,000 a month, $4,000 a month. You need $70,000 for down payment and closing costs. You're going to need another 4 months payment, up to 4 months payment. left over in the bank. You have to show this to your to the mortgage processor. You're not going to be able to close on the house on a conventional loan if you're using every available dollar you have. Even if you're like, you have a paycheck coming in, oh, I'm going to make money, at the closing table on closing day, you need to have an additional, 2 to 4 months of funds available after all the costs to close on a conventional loan. Seller concessions, seller giving money to the buyer to help with closing costs. It depends on the down payment amount, but yes, seller concessions are allowed. Non-occupying co-borrower. This is a co-signer, somebody who's going to buy the mortgage and not live in the house. Is it allowed? No, it is not allowed for a conventional, traditional mortgage loan. Okay. Are loans assumable? Meaning, can you give them to somebody? Can somebody come assume your mortgage? Generally, they are not. And your income, employment history, you're going to need 2 years of income and employment history to qualify yourself for that home. Okay. And let's just go while we're here. I'll jump right to the FHA limits, and then we'll get into the numbers, putting together a specific package and putting together your home. We'll jump down to the FHA limits. Okay. All right. FHA loans, you're allowed to have a housing expense up to 31%. Okay. You can have total debt service up to 43%. Okay. So this is, you're using a greater percentage of your income to buy a house. You may have additional obligations financially that you're paying back monthly. So the maximum debt is the debt service, the top end number there is increased from 36 to 43%. Okay. You can put up to 3.5% down. All right. That's less than conventional. Or just so you know, so conventional you're allowed is the lowest down payment option. FHA 3.5%, conventional 3%. Okay. You can have a credit score as low as 580 with 3.5% down. If you have a 500 to 580 credit score, you can still buy a home if you can put down 10% or more. Annual mortgage insurance, yes, this is required. Again, this is like the mortgage insurance premium. And upfront mortgage insurance. This is a major difference in the closing cost between a conventional and an FHA loan. Upfront mortgage insurance is 1.75% of the loan. Okay, 1.75% of the loan. That is a big number when you're talking about homes in Bronx and Westchester County. $500,000 house, a $400,000 loan. That's a payment upfront, additional closing cost of almost 2%, almost $8,000 on a $400,000 loan. Okay, and we're gonna break down all the closing costs. Are appraisals required on FHA loans? 100%. You find a house, it's highly competitive, you're making an offer, the seller wants the appraisal waived. When you waive the appraisal if you have an FHA loan? No, you can't. Gift funds, are they allowed? Yes, gift funds are going to be allowed. Again, has to come from a blood relative, has to not be paid back. The person giving you the gift is going to have to sign off that they're giving you this money to buy a house and you do not owe them that money. Okay, that will need to be documented. With bankruptcy, a little bit more lenient with FHA loans in regards to bankruptcies and foreclosure. 2 years after a Chapter 7 discharge, 1 year after a Chapter 13 filing. So if you filed Chapter 13 bankruptcy, you filed it, you've made your payments 1 year after you filed it, you can still qualify for an FHA mortgage loan. And 3 years from foreclosure or short sale for an FHA loan. So if you foreclosed in the last 3 years, you still have an option to get to buy a new home. Reserves, there's no reserve requirement with FHA loans. Seller's concessions, they're allowed to give you up to 6% of the value of the loan in terms of closing costs. Okay. Now closing costs on an FHA loan are probably going to be around 5% of the total cost of the home. So they're basically allowed to pay for all of the closing on there. They can't give you anything more because again, your closing costs are only going to be about 5% of the loan cost. Okay. Non-occupying co-borrower. Can you have a co-signer for a home? Yes, you can with an FHA loan. You cannot with a conventional. Are FHA loans assumable? Yes. So you could buy a house with an FHA loan. Somebody who passes an FHA credit worthiness check can assume your mortgage. So if you get into trouble, okay, you have a family member willing to take over your mortgage so you don't lose the house, you could do that. Because FHA mortgages are assumable. The FHA loans, you're a little bit less strict on employment history. There's no specific requirement that you have done, this for like 2 years. That's FHA policy. Any individual bank is going to have their own policy. Okay, so what we're looking at here is just the government protocol. Banks specifically have their own set. They're usually in line. They're not going to be less strict. If anything, there would just be more. They're not allowed to be less strict. Okay. Not any longer since the housing crisis. All of these lending practices, qualifications, disclosures, they are very, very highly scrutinized. So you're not going to see less strict qualifications on conventional qualified mortgages. Okay, you can get some non-qualified mortgages, non-QM. They're called hard money loans, no doc loans, things like that. But that's money from a private lender. It's not federally backed. It's not seen as a conventional mortgage. It's more of a loan, almost like a business loan. Okay. And owner occupancy. Yes, if you buy a house with an FHA loan, you must move in within 60 days and continue occupancy for 1 year. Right. So you likely cannot buy a home that needs a full renovation with an FHA loan because you're not going to be able to move in there within 60 days. If the home is occupied, if you're looking at like a multifamily house and there's 2 tenants in it, you probably can't do this FHA loan if you are not able to move in within 60 days. So if the property is leased throughout the year, all right, can you buy a multifamily property with an FHA loan? Yes, you can, but you need to be an owner occupant. You can't buy it as an investor and have somebody else living there and just paying you back. You won't be able to qualify for an FHA loan. And then for investment properties, for multifamily properties, you need to put down at least 15% for like a conventional loan. In general, a lot of the times with the FHA too, sometimes like you may need to put down 15% or more. 15 to 25% could be the minimum for a multifamily property if you are not going to be living in there. Okay, so that's that. That was a lot, really fast. I definitely understand that. Let's talk about specifically. We're going to look at your putting together income, purchase price, down payment, interest rates, all that together right now. Really look into what goes into you qualifying for a loan. Again, if you're still there, please hit the like button, subscribe, stick around. We're going to see a lot more. And if you have questions, you can hit me on WhatsApp. The link is in the description for the video. You can email me, find other sites, and also, follow me on the gram. Feel free to slide up in the DMs. I will respond and answer your question. I'm here to answer your questions to serve you, reach your goals in real estate. All right. So let's go now back to our purchase here. So let's take a look at, we see our income, we have our income limits, this and that. Now let's look at the purchase price of a home, and then we're going to be able to see if we qualify for an FHA or a conventional loan based on the purchase price and how we could change it or move those numbers around to find something that fits for us. Okay, so we'll go up here. All right, so I make $150,000 a year I make $12,500 a month. Okay, the maximum I could borrow for a conventional loan monthly for my house is $3,500. The maximum I could borrow for the FHA loan for my house is $3,875. I put together here a little chart. This will break down my monthly payment if I bought this house. So if I did, let me back this up so we could see a little bit more of the screen. There we go. So if we're putting together, we found a house, we're making the offer, the purchase price is $600,000. In this scenario, I'm going to put down 20% because I'm going to pay mortgage insurance. I am going to borrow $480,000. Interest rate is 3%. Taxes on the house are $6,000. Insurance annually. Okay, taxes and insurance, association, and mortgage insurance premium. They're going to be listed here as annual numbers and broken down into the monthly payment. I'll show you down here. Okay, what does that look like for me? That's going to leave me with a monthly PITIA payment, okay? PITIA, the principal, the interest, the tax, the insurance, the HOA, the total cost, that total mortgage payment, interest, principal, taxes, insurance, association, monthly payment, mortgage balance. All right. What is that going to look like? It's going to leave me with a $2,600 a month payment. My housing expense ratio is about 21%. My total debt service coverage ratio is about 32%. I am well within conventional loan limits. I could get a conventional loan. My closing costs could be about $14,000. Again, conventional loans, their closing costs are usually around 3%, 3 to 3.5%. FHA loans, you're looking 4.5 to 5.5% closing costs. Again, because the upfront mortgage insurance premium is an additional closing cost with FHA loans. That's mandatory, and it is about it is 1.75% of the loan. Mortgage insurance premium, this number could be anywhere from like 4.5 up to about 1.5, depending on the loan to value, your credit score, and the purchase price of a home. All three of those things are going to affect it, but overall, like you get about 0.85% of the loan will be your annual mortgage insurance premium. You divide that number by 12, and it becomes your a payment, which is basically like the lender's insurance to that gets added to you monthly. Okay, so I'm well within this, but altogether, this loan would cost me to buy. This house would cost me to buy upfront money. I would need $120,000. I would need $14,000. Okay, we're gonna put all these numbers right here. Everything we need to qualify for this house. All right, I'm gonna need $120,000 up front. I'm going to need $14,000 for closing costs, and I'm going to need 3 to 4 months of reserves. Let's just say 4 months of reserves. So I'm going to put this times 4 cash on hand to close on this house. Yeah. Why is that error? Let's fix that. Oh, come on. Making me look silly over here, Google Sheets. I'm going to need $144,000 to close on this home. Maybe if I don't have that type of money, I need to adjust my down payment, see if it still works. If I don't want to spend all of that money, maybe I have some other, needs in my life. Maybe we're looking to renovate the house or go on vacation or do something. Maybe let's say I have about $125,000 available that I want to spend on buying this house. So let's see if I drop down my payment to 15%. All right, I'm taking $30,000 off of my down payment. Well, now that you see the mortgage insurance premium kicked in. Okay, so my loan got bigger. 0.85% of the loan became $4,335, which monthly works out to $361 in the first year. If you look towards the second year, your loan balance dropped down after 1 year. And then in the second year, your mortgage insurance premium is going to drop. When you get 78% equity in the home, mortgage insurance premium automatically goes away on conventional loans. For an A loan, your mortgage insurance premium is for the life of the loan. No matter how long you pay that loan, with an FHA loan, you will pay the monthly insurance premium. Even if you owe $1 of mortgage, you're going to pay a mortgage insurance premium on that loan. So again, something to think about with FHA versus conventional loans. All right. So closing, I'm going to need less money, $117,000. All right. Well, that's great. And now we got to look at, does this still work? Well, as you can see here, you're not going to cover the debt service ratio with this purchase package because your debt service coverage is 36.89%. All right, because your monthly payment went up, your income didn't change, the payment on the house changed. All right, your monthly service, your debt service coverage ratio went up. It is above the allowed limit. You will now not qualify for a conventional mortgage, all things being the same, with 15% down. Right. So what could we do to make this work? Now this number is kind of close. So maybe I just kick this to 18%. Still more than I wanted to put down, but I'm still out of the debt service coverage ratio. Still don't qualify for a conventional loan based on basic underwriting. All right, so this is not going to work as for a conventional loan. Instead of that, I may have to put 15% down. My closing costs are now going to be this number. Okay. 15% down, $125,000 up front, right where I want it to be. I could get an FHA loan still. So to purchase this home. So you can get a 15% down FHA loan, same purchase price, same interest rate, same income. All right. But you could see how, all of these, putting together your mortgage has a lot of moving parts. Again, a lot of this information you're taking in, you may not be the question that you had specifically in mind, but if you want to talk to me specifically, again, contact information in the bio, ask me a question, send me your setup, what you're looking at, and let's see if we could put together a good deal for you or a good plan and see what, which best way we could do it. Okay. Now, these are the numbers if you're like borderline of qualifying, not qualifying FHA conventional loans. Let's say you're extremely qualified. Maybe you and your family together make $225,000 a year. You're looking at a house that's $700,000. Okay. You barely have any money. That's a lot less monthly debt. Okay. For somebody making a little bit more, $18,000 a month, $1,000 in expenses is extremely low. You have an excellent credit. You're going to get a great interest rate. All right. Maybe your interest rate is 2.98%. All right. You're going to have no problem getting a loan. Now it becomes, what is the best use of my money? How do I, what's the best use of my money? How am I going to save? What's the best plan for me? How do I put some of that together? I don't want to be taken advantage of or just buy something that, that I want. First and foremost, right, you're going to be concerned with monthly payment. How much is it monthly? $3,500 a month. It's not an issue. You're well within housing ratio expenses there. You maybe even be able to afford some additional payments there. What's the difference here between your monthly payment and your monthly income? It's this number minus this number. All right, that $15,000. Now let's talk about what that money means to you and how we could best use it. Okay, how we could best use this number over here. I want to talk about maybe sometimes using discount points to get a lower interest rate on a loan. All right, if you were at 3.5% and you're going to put 20% down on a mortgage, your total closing costs, again, they're going to be somewhere around 170. Your principal interest payments becomes 2514. Your monthly payment is at 3114. So I'm going to write this number over here, 3114. All right. What if I buy down my interest rate, okay, with a discount point? Generally, I could pay a fee of about 1% of a mortgage to lower my interest rate. So if I did it right at 20%, I get my rate, let's say I get my rate down to 2.5%. I'm going to, the difference there, I'm going to save close to about $300 a month. Now, is paying $5,600, 1% of the mortgage as a discount point, worth saving $300 a month? Now, $300 a month for 30 years, possibly you're going to make a lot of money down the line. What about if I put 15% down, so $35,000 less down payment, and I buy that discount point? Well, now my monthly payment is $33.72. So I'm paying a little bit more monthly, but I'm putting down $30,000 less on the house. Buying a discount point at $6,000. That's $24,000 extra in my pocket up front for a $200 a month payment difference. Do I need that $24,000 extra up front? Do I, would I rather have the lower monthly payment? All of these things are specific to you. You have to, we could sit down together, really work it out, see exactly how, this is going to fit for you. Always, $20,000 eliminates monthly mortgage insurance. You're eliminating the mortgage insurance premium, okay? And you are going to have the lowest possible payment, but you're giving up as much, the most cash up front. And you have to consider all of those things when choosing the best, mortgage plan for you. It's not, hey, I'm going to get a loan, I'm going to put 5% down. If you put 5% down on this house, if this is your scenario here, if you make $225 a year, yeah, you're going to still qualify for a conventional mortgage. You're going to be paying $3,600 a month, $3,698. You're going to pay a higher amount in closing costs, but you're going to leave with $50,000 out of pocket when before you were looking at $100 and something thousand out of pocket. So, you could save by spending an extra $500 a month. You're going to keep $50,000 extra in your pocket, putting 5% down versus 15% down on the home. What is worth more to you? What's your plan? Are you a younger person buying a house and you're going to live there for 5 to 10 years and then likely move? Is your family expanding? Are you older and your kids are out of the house and nobody's going to, you don't expect a lot of life changes, major life changes in terms of employment or location or opportunity in the next, like 10 to 20 years? You're winding down in life. You've gone through all the changes you had. I want something, I just easy monthly payment, and I'm not really concerned about 20 years from now, getting a lower down payment if you can cover the income might be better. Maybe better is to have your cash on hand and go travel. Again, if you were younger, I would be trying to make the best financial purchase possible for my future. Okay, especially if I planned on moving within 5 to 10 years, I would be doing as much as possible to bring the total cost of the home down, of the total cost of the mortgage. That means putting down as much as I could. Now, if you are like currently renting a house and you're paying rent, you need more space. You need more space. I have like 2 or 3 kids who live in an apartment. I need the house. Well, being picky over here with I will only buy a house if my costs stay really low. I will only buy a house if it's in a certain area, certain neighborhood. If you're paying rent, every one of those dollars every month is going out the door. If you are going if you're going to buy a house, if you need bigger space, You need to do what you got to do to get into the property within your means. Okay, I'm not saying, don't buy something that you can't afford, but if, buy something you can afford. All right, if this interest rate is 4%, and you look at a decent sized single family house, 250, 550. All right, let's say it's it's in a nice neighborhood, but $5,500 in taxes you can get away with. Okay, 5% down, monthly insurance premium, buying 520, 4% interest rate. My monthly payment's going to be $3,400 a month. If my household income is 175,000, husband and wife, 2 jobs, 175,000, we're going to be able to qualify. We're going to be able to qualify for an FHA loan or a conventional loan. If I have these available funds to close on a house, today I would. If your mindset is, well, I'm not paying this much interest, and this much of this going through this process to buy a house, to pay that much money a month. Well, if you're renting a house and it's costing you $2,000 to $3,000 a month right now, paying $3,400 a month is a really, really good number. Also, as part of this payment, $3,400 a month, this principal payment, $752, that the portion of this monthly payment, that's money that goes directly back to you. So you are saving $752, $755, $757, $760, and more as you pay down the balance of the house in the house. Okay, so your mortgage payment includes money that you are giving back to yourself when you are paying this down. All right, so this, when looking at your overall financial picture, if this is your option, if this is something that's available to you, even at 4% interest rate, if you think that's unfair, if you think you would have bought a house if you got it at 3%, but now it's 4%, but you're renting a place still, if you're paying $2,500 a month to rent, that money's going out the door, you get nothing for it. Okay, you are giving yourself $800 a month at 4% interest immediately, plus the appreciation value and the equity you have in the home, right all up front. Again, it's a no-brainer. If you have a house, if you have substantial assets, and this is another asset that you're looking at, then it becomes you have a house, but how do I best position and structure the deal where I get the most value out of it, and it saves me the most money? That's when you have that ability to do that when you're already in the game. If you're not in the game, you got to get in the game, find something to make it work, find a house that you do like, and let's put together a deal for you and make it happen. All right, so now taxes. How do taxes affect your qualification? It was like, well, 550,000, this amount of taxes would be normal for a house maybe in New York City. If you're looking in Westchester County, these taxes could easily be, I'm going to say $12,000 on this house. Okay, now the same purchase price, same interest rate. Now you don't qualify debt service wise to buy to get this house. Okay, you're not going to qualify for a conventional loan at this purchase price with this down payment with this amount of debt. Another thing to look at is how you can move debt back and forth to help you qualify. All right, because the only way you're going to lower this payment down to under 36% is like, well, I have to put 15% down. Does that work? Yeah. Okay. You got to put down another $50,000 to get that debt service coverage ratio to work. Maybe that works. Maybe you have a loan, a car loan. It's $250 a month. Okay, it's a $15,000 loan. What if you took $15,000 and instead of putting an extra down payment on your house, lowered your monthly debt to $1,250? Okay, just lowering your monthly debt by paying off your car loan got you into the house and kept you within the debt service coverage ratio to qualify for a conventional loan versus an FHA loan. All right, so you didn't have to put down $50,000. You had to pay $15,000 of your car loan off. Okay, all of those things, every little thing is included in your, qualifying picture. Knowing what to do, where to move, what's the best option for me. We can look at and lay out everything that is available, all the information that is available. What is your desk? What are your goals? What are your obligations? Okay. And again, we're talking about the housing expense, qualifying a mortgage, conventional versus FHA loans over there. What is the best thing for you to do? I would always, again, start by liking, subscribing, please, and reach out to me, contact me, hit those site there. You can just, like I said, you can just message me on WhatsApp or let me know what's going on. I'd be happy to jump in and help you analyze your situation. Okay. So we went over conventional loan limits, FHA loan limits. We talked about the housing expense, principal, interest, taxes, insurance, associations. We see how all the associations, like if it's an HOA fee or if it's a co-op or a condo, what are their association fees? You look at it annually, you break it down monthly, it's going to go into your payment. All right. The debt service, your housing expense, whatever's on your credit report, whatever's government ordered. Okay. And then now upfront mortgage insurance and premium. Again, major difference between FHA loans and conventional loans. FHA loans, if that's what you qualify for, the additional closing cost is an extra 1.75% of your loan upfront. Now let me look at, sorry about that. I'm going to get this mortgage paper up here. Okay. Give me 1 second. Okay. All right, so this is monthly mortgage payment. Sorry about that. So this is the monthly mortgage payment. How does it break down? Monthly mortgage insurance premium. How does it break down? If your loan is less than $625,000, and that's less than or equal to 90% loan to value, meaning you have less than 10% down, you're going to be paying about 80 basis points for mortgage insurance premium instead of 0.8% instead of 0.85. Okay. If your mortgage term is less than 11 years, for 11 years on the loan, that's how it looks. If you're putting 5% or less down on the home for conventional loan, 0.85%. Okay. If your loan is larger than 625,000, your mortgage insurance premium goes up a little bit to 100 or more. If you are doing a 15-year or less mortgage loan, you could be paying less mortgage insurance premium monthly. Again, your mortgage principal and payment is higher monthly. The interest payment is going to be less on a 15-year mortgage. Your mortgage insurance premium is going to be less. So while your out-of-pocket cash is less for a shorter mortgage, the cost of that mortgage is much less. Okay, you're even charging you less of a mortgage insurance premium for a loan less than 15 years. Okay, now I said back to the upfront mortgage insurance premium, qualified on every mortgage backed by an FHA loan that meets FHA guidelines and not conventional guidelines. Okay, so we pay into this fund with the reason we're not penalizing people who have less, not fantastic credit, who don't have, who have extra expenses with families, things like that. Don't think of it as a penalty on there. That money goes to ensure the loans that the bank is able to lend out. The banks would not lend out money to someone with a 600 credit score and a 40% debt service coverage ratio if that money was not insured by things like the like the upfront mortgage insurance premium and the monthly insurance mortgage premium. Okay, those go to the government so they can continue backing the loans that are letting people get into the home ownership market and buy a lot of their stuff. Okay, so now interest rate, again, but when I showed that breakdown, I didn't even talk about, I showed the effects of how if one number moves, it can knock you in or out of qualifying conventional or FHA loans. Now I'm going to talk about interest rates. What is going into my interest rate? What is obviously your credit score is going into your interest rate. Where are the interest rates moving? How could I project my rate? When is a good time for it? The bank itself is going to have a margin on the loan, right? So depending on the bank you use, it depends on how much money they need to make on the loan. That part of that is your interest rate. And then, going into what could I expect for 2022? How do I look at interest rates? You know where they are now. If you've been pre-qualified for a loan, you get a pre-qualification. Great. Here's your loan. Here's the interest rate we can qualify for you today, but it's not locked. It's not locked if you just get a pre-qualification, or if you just get a screening from a lender, or even if you just apply for a loan, that loan may not be locked. I mean, you could pay to lock it, but it may not be locked, and the interest rate's going to continue to move. How do I know where it's going? If I have a closing scheduled for this week, like, do I feel safe about that? Do I want to push the closing back? How look in the short term where interest rates are going? Over the long term, over the next, if you're looking just as next year, as 2022, as a year, as a time frame in general, are interest rates going to rise? Yes, the majority of experts, financial economic experts, are expecting interest rates to rise, 0.2 to 0.4%. So the average interest rate right now is 3.2% on a loan. Is that going to go up to 3.4, 3.5, 3.6 by the end of the year? Yeah, but it's going to bounce. This is not straight line trajectory. These things do bounce. The best way to view this is to look at the mortgage-backed securities market. Tracking these markets is how professionals, like in the short term, kind of try to time your mortgage as to the best of their ability. So let's look at, I'm gonna look at the Vanguard mortgage-backed security fund, EFT fund, right now. So this is a 5-year period. So what is happening here? This really squiggly purple line right here, this is actually the price of the fund. Okay, so as the yield on the fund increases, okay, as this price increases, that is a decrease in interest rate. All right. So as the yield on mortgage-backed security funds increases, right, as this price point goes up and goes up, mortgage rates are decreasing. Mortgage rates decrease, more people buy mortgage rates. These funds become higher because banks make more money. Less people buy mortgages, the value of this fund goes down, right? So as the fund goes down, interest rates are probably going up. As the fund goes up, interest rates are going down, and that's how we take a look at and that's how, somebody has a good idea about where the market's going in the immediate future. So if you're looking for someone to check your rate, when is the time to refinance? You maybe want to, look at something like this. If it's trending up, maybe I'm going to wait for a downturn, because these downturns here, this whole downturn is a 2-week period. This little arc up right here, this downturn, this increase in rates from here to here, right, was a good, what, 4 weeks? It's 4 weeks earlier in the year where rates went down, 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 down. And then the market changed. And you have, 4 weeks where it went up, 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 up. And then down, 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 down. Okay, so they're going to move. They're going to, you don't want to be here. You don't want to start your refinance purchase at this price point, not knowing what was going on with the trend. And then next thing you know, you're going to close here and you're paying a higher interest rate. Well, in this case, that would have been a lower interest rate, but you want to be able to start here and then close over here. You're going to save yourself some money because you're going to get a lower average interest rate. You don't want to start to, you don't want to start your process here, and then you wind up closing down here, and you're going to get higher interest rates. So, this is how we kind of really time the market. And then what are these other bands right here? The shaded area are Bollinger Band, okay? And this is the real, this is like the Fibonacci sequence that stocks investor uses. when the investors use when they analyze just pricing across the market. That is how high or low something can go. It's blown up really big on my screen, so it looks like it's a big area, but you're talking about 5.3 down to, like 5.271, less than less than 1 point, or less than $1 of a $53 stock. So that's really, we're talking about what's that, 2%, right? So you have a 2% yield return. That's not a big fluctuation when it comes to interest rate price. All right, it's like 2 basis points is not a lot, but it can go up or down, but it should stay within those numbers. And then what are these smoother purple and orange bands? It's like, well, the orange band is the moving average from like the 1-day moving average. What's the average price over the last over a shorter period, over the last day? The purple band is the moving average over the last 50 days. So when you're looking at stocks, when you're looking at cryptocurrency, right, things like that, when the short-term moving average comes under the long-term moving average, that means you can expect a decrease in the value of the stock. Okay, you could look it up, rolling moving averages and how they're used to price stocks and predict stock market and predict trends. You can see here, January 2021, the long-term moving average and the short-term moving average crossed over. What is that? So the second this happened, the second people saw that the long-term moving average was moving above the short-term moving average, the second you're looking at this convergence right over here, okay, when you see this slope and you see this slope, if you were on December 28th, you're like, uh-oh, interest rates are going to rise. Why? Because I'm looking at these rolling trends over here, and then what happened shortly after over the next couple of months. Remember, I said the lower the value of this fund, the higher interest rates are. So you were able to predict kind of over here that interest rates were going to increase because this was going to happen. And rates have been continually to slowly, again, increase as the year is coming to an end. I'm looking at this really wonky. Sorry about that. I'll switch it back. If you're looking at over a 3-month period, it doesn't look as drastic. We're looking at a 5-month period before. You see there was some volatility. Interest rates really increased from February into early March, and then it's been relatively level. This is like pretty flat. Again, it looks like it's going up and down, but this chart is starting at 53, and then up here is 53.75. So it looks very drastic, but these are small movements. Like in the long run, this is a pretty level and sound, looks like a healthy market. There's not a ton of volatility the way there was, way earlier in the year and into 2020. In 2020, besides the one little hiccup in March and April, it's been looking pretty smooth. So you could see the trend lines over here, they're starting to converge a little bit. They're getting a little bit closer. So you might expect some easing or at least even a slowing of interest rate appreciation. Okay, they're not getting real close to where they're going to cross and where interest rates are going to drop significantly, but they should be relatively steady if you're looking over the next over the next 3 months. If you're looking at a 6-month window, they're looking really steady, so there shouldn't be a lot of movement. They're sloping a little bit down, but not too much down, so you're not going to see a drastic change. And then again, if your interest rate goes from 3.2 to 3.25 to 3.3, what does that mean for you monthly? It's not the end of the world. Let's bring back up the purchase outlook so we could see exactly what that looks like there. What that small percentage change is. Okay. Oops, that's down payment. All right. If your interest rate is 3% on a $522,000 loan, your monthly payment is going to be $36.72. If your interest rate is 3.15%, interest rates way up, okay, it's 37.15. Okay, so 0.15% knock you up, less than $100. If it's 3.3%, $3,758. So interest rate increases are not the end of the world. If this interest rate was 3.5%, $3,800. If the interest rate's 3.3%, $3,700. Only if that knocks you out of, if you're very close to this limit here, then it makes a big difference. You may have to go from a conventional to an FHA loan. You may fall out of FHA loan qualifications if you're borderline. But if you're within, 3 to 4% debt service coverage ratio is a future increase, right? Even if it increased 0.1, 0.2%, are you going to be able to close on a house? Yeah. If this is your scenario, you're still going to be able to close on a house. If you're looking towards much later end of the year to buy a house, not only does the interest rate go up to 3.6%, but the price may go up because housing has continued to rise. Prices are still going up. So the cost of that home is now going to be, $3,900 a month. So if you wait, not only is the interest rate going to go up, but the purchase price is also going to go up. Okay. Now that's a little bit more significant of a difference. If you had a house today, you could have paid $3,700 a month. You waited till the end of the year. You're now paying for the same more money at a higher rate, and you're going to be paying, an additional $200 or more a month for the same exact house for the same exact price. Okay. Another last couple of things I want to touch on. APR, you'll see this number. This is the number that lenders would advertise. It is the total cost of the mortgage. So annual as expressed as a ratio of the value of the mortgage. So all of your closing costs tied in with discount points that you might pay, plus your interest rate, plus the interest that you're going to be paying on the loan in the first year as a ratio of the loan. That is the APR. Governments track the APR to make sure people are not giving you too high priced loans. Okay. You have, there are high priced mortgages, which require a lot of upfront fees. They are legal, but there are disclosures that a lender is required to give you so that you know that you're paying for a high priced mortgage. Okay. So APR is about the price of the mortgage. It's not the interest rate. That's, when you're comparing APRs, if you're calling different banks and they say, oh, I have an APR 4.5 APR, 4.75. It's not your interest rate. It's the price of the loan. It's everything else, including closing costs and fees associated with the lender into your mortgage loan. And then adjustable rate mortgages. I didn't go into it and break it down. It's a whole nother subject. But an adjustable rate mortgage, you'll see it in 3 lines. There'll be 3 numbers at the end of the mortgage. The first number is your initial interest rate. The second number is the adjustment that can be applied at said adjustment period. So a 1-year ARM, 1-year adjustable mortgage, every 1 year, the interest rate can change by the amount that is the second number. That's the max it could change by any amount that is the second number. So if you're getting an introductory rate of 2.5%, okay, the adjustment is 2%. That's the max that your interest rate can change. Then, even if interest rates rose, if the index rate, the rate that the number is based off of, if that rose, 3%, you have a max adjustment cap, and that is 2%. So you can only go from 2.5% to 4% to 4.5%, not 5.5%. And then lifetime cap may be a number like 6, 7, 8%. That's the maximum amount it could change at any given time. Okay, so keep in mind. So if that adjustment period is 2%, that's the max that it could cap at any adjustment period. The lifetime cap is the most that I could go, period. So if you're getting a 2.5% initial rate every adjustment, it can go 2%. No matter how high the index goes, you can only go up to 4.5% from period 1 to period 2. But now period 3, you can go from 4.5% to 6.5%. Things continue to go up, 6.5% to 8.5%. And then the lifetime cap is the maximum amount percent it could be. So if your max cap is 8, 8 is the highest interest rate you could possibly go on the loan. Now, you wouldn't want to get an adjustable rate loan at a time thought interest rates were going to increase and the index were going to increase. To do that, you need to go back and look at something like, like the mortgage-backed securities market thing that we were checking at before. Maybe you want to really check if you have the ability to tolerate those adjustments down the line a year or 2 years from now. If you know that, if you're getting into a very safe, mortgage for yourself, that's a very low portion of your total monthly income, that even if that rate, your interest rate increased, 6, 7, 8%, you're still not going to be affected by it. An adjustable rate can be a good idea. A 5 right now is something that may look like a good idea. Interest rates have kind of move in this 3 to 4 year cycle. So maybe you would expect interest rates to gradually increase over the next 3 years and then probably start coming back down. So what about a 5/1 ARM? If I get into a 5/1 ARM, it has a low introduction. I'm getting a rate at 2.7% for 5 years, and then it's going to adjust every year. Well, if I'm at 2.75% and interest rates adjust for 3 years and then start to come back down, I was able to skip the whole rate increase period. And I got a lower interest rate than I would have gotten if I would have gotten a fixed rate loan. Maybe I would have got a fixed rate loan at 3.1%. So I saved myself 2.5% interest, 0.25% interest for 5 years, a month for 5 years, and then interest rates are going to come back down. Is that a risk that it comes back down? Absolutely. Are they definitely going to come back down? No. Can I tolerate whatever's going to happen in that 5th year? Okay, like maybe my house is more paid off. I'm going to sell the house in 3 years anyway. I'm buying this because my son is going to college, and I'm investing in a property that he's going to live in, and I'm going to sell it when he graduates. So I'm only looking to have this property for 4 years. A 5/1 ARM, a 3/1 ARM, something like that may be an option that saves you a lot of money, but you got to be smart about it. You got to look at the big picture and what is available to you. Just keep in mind, right? Your number one goal going into a decision on real estate is going to be equity growth. How much money am I saving? What am I worth? What are my options worth? What is the best option for myself, for my needs, for my family, for my future? All right, I'm going to continue giving you information to help you make that. Please, if you have any questions, reach me on my link tree. You can find me through WhatsApp, email, send me a message, Instagram, all the YouTube channels, this and that. Follow and like me on Instagram. Check it out. I post some cool stuff. Okay. And hit that like button. Please subscribe. Thank you again for watching. I gave you a lot of information. If you have any questions, please give me a call back. If you have specific questions about available loan programs, about first-time homebuyer home programs, first-time homebuyer programs are specific to the state that you're in. Okay, if you're looking for down payment assistance, it's going to come from the state, not from the bank. A bank can roll some of your closing costs into a loan, maybe. All right, so the bank could finance some upfront costs for you in your loan. But as far as grants and assistance, SonyMA, SonyMA, is the agency in the state of New York, the state of New York Mortgage agency or authority, one of those. All right, SonyMA is where you would go for information for first-time homebuyer grants and down payment assistance. Okay, so you just Google them, check those out. And again, I look forward to continuing to bring you this information, to continue helping you on your real estate, building your empire, getting you the mortgages, getting you the deals that you want, and getting you the information to help you make the best decision for yourself and your family. Thank you, everyone. Have a great day.